Hi there, this is Dennis. And did you know that when you are shopping for a mortgage rate, you're also choosing between the two different ways your lender gets paid? And this choice affects both your rate and your closing cost. Let me break it down for you. One of the questions I hear all the time is, how do you get paid? As a lender, we get paid one of two ways, either by the investor, which is lender paid, or by the borrower, borrower paid. Each way is acceptable, but the lender just cannot get paid both ways on the same loan, so you can't double dip. Now, with lender paid comp, you pay no broker compensation fee, zero. At closing, there's no fee line item for the lender. Instead, the investor covers the cost of the lender through what is called the gain on the sale. So when we lock you in at a particular rate, we sell it on the secondary market, and the spread between what we sell it for and what it costs is our yield spread, and that's how a lender gets paid with lender paid compensation. So you don't see it as a direct fee, but you do see it in your interest rate because your interest rate is slightly higher because the lender is using yield spread to compensate themselves and their company. Now, with borrower paid comp, you pay an origination or broker fee to the lender directly at closing. That fee might be 2.5% of your loan amount, but in exchange, you get a slightly lower rate because the lender isn't relying on yield spread to get their compensation, because they're getting their compensation straight from you, so they can offer you that slightly better interest rate. Here's what the key insight is on all of this. Both models cost money. The question is when and how you pay it. With the lender paid comp, you pay through a slightly higher rate over the life of the loan. With borrower paid, you pay upfront at closing. Someone might ask, which one is best? It really depends on your situation. Lender paid compensation works if you're short on cash at closing, if you don't want to bring money to the table, or if you're planning to sell or refinance in the relative soon future. That higher rate doesn't cost you that much over time. Borrower paid comp works if you do have that cash available for closing, you're staying long term, and you want to get the absolute lowest rate that you can get. So let's say you have two offers. One is lender paid at a higher rate with no compensation fee. The other is borrower paid, a $5,000 compensation fee and a lower rate. If that quarter% difference saves you roughly $50 a month on a $400,000 loan, your break even on the $5,000 fee is about 100 months or just over 8 years. So if you're staying longer than that, borrower paid wins. If you're selling in 5 years or refinancing in under 8, that lender paid would have been the right call. So the trap is thinking that one model is always better. They're not. They're just different paths to get the lender compensated, and every business has to make money in order to stay in business and help more people. So do the math on your specific situation, know your timeline, and pick the model that aligns with your plans. The bottom line is every mortgage is paid for one of two ways, and most lenders never explain the choice. I've explained the lender paid versus borrower paid compensation model to you in plain English. What if we hopped on a call and we talked about how you can choose the one that best fits your situation?